Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy updates. This week I'm going to look at what was behind last week's tech stock correction and the general fallback in some of the growth names which have been the anchor of the market this year and indeed for several years before. You can see the scale of the decline on the left-hand side of slide 2. The blue index is the S&P 500, still up 3% for the year, but off about 5% in the last 5 days, quite meaningful. On the top line, you can see the FANG Plus index. That is the big super tech stocks, Facebook, Apple, Amazon, Netflix, Google, but also Alibaba and Baidu in China, Nvidia, Tesla, and Twitter. That fell 13% on the week. Indeed, Nasdaq fell 9%. So these are quite meaningful numbers, and equity volatility rose sharply. Now, of course, some correction was inevitable. The returns from FANG Plus are a staggering 62% still this year, compared to 3% for the main S&P 500 index. And if you look to the right, that's part of a very big growth rally. The Russell 1000 growth index in red compared to the Russell 1000 value index in blue over the last 5 years. One of the greatest divergences of equity style we've ever seen. So some correction, I think, was inevitable, particularly as this was beginning to suck in a lot of retail investors using the Robinhood and other platforms. They were aggressively pushing on technology stocks and particularly technology options. So what triggered the correction, and is it likely to continue? Well, the first point was, I think, a mixed message over the virus numbers. And I think on the one side, this was a depressing message. It was an uptick in Europe, and particularly the stringency index seeming to be stuck in most of the world countries, somewhere between the 50s and 70s mark. Indeed, everybody who's tried to ease, bring their index down, unlock, has had to relock, as we've seen with Italy and France, and we're now seeing with the UK. Indeed, that UK index of 64% will probably tick up on Monday once the 6-person limit begins to become a legal requirement. So I think frustration that we can't unlock economies faster. On the other side, I think the market looked at improving daily cases in the US, that's on the left here, and particularly in the red line, falling daily hospitalizations and a lower test rate. Interesting, even in the UK, where you can see the blue line, the COVID cases has ticked up quite markedly. Hospitalization and test rates are still looking quite good. Treatments are improving. These are younger people who are generally infected. And we're not seeing the aggressive feed through. So perhaps the market sensed a possible opportunity to continue to see economic growth despite the lockdown. And it's just one number. We had this morning the UK GDP numbers for July. We're one of the few countries that publishes monthly numbers, and that's 6.6% positive. That continued a very robust uptick. Now, the economy is up 18% from the low, but still 11% smaller than it was in February, so it's still a very sharp drawdown, but the numbers were somewhat improved. The second point is politics. Trump's numbers have begun to improve slightly. Now, it's not a worry necessarily of a Trump victory. It's worry that if those numbers improve, the possibility of a contested victory, some sort of battle over the outcome, some legal challenge, becomes much higher. You can see a slight uptick in the Trump numbers, fallen from a lead of Biden from about 10 to about 7.5. On the right, where there is a little bit of a change, is the Real Geopolitics poll of how the US public see the president's skills on the economy, his job approval rate. And that has widened quite, moved back in favor of Trump, up 3.5%, nothing to what we were. But you can see the sort of trends. Now, why does it worry the market? Well, I think that's clear if you look at how stock markets behaved in early elections. On the left-hand chart, I've shown the year-to-date 2020 electoral year in red. 2016, the stock market S&P 500 under the Hillary-Trump campaign. And then in the light blue, I've shown the 2000 election of Bush and Gore. Now, why have I picked this? Well, if you remember, there was at least 1 month of contested outcomes as people battled in the courts over the count in Florida, ending with a 5-4 decision of the Supreme Court. Now, you can see the stock market fell sharply. It didn't like that. Bond yields came down on the right sharply. And you can see the sort of volatility that we might get from a contested outcome. Issue 3 for the market, I think, is a deeper and longer term one. It's that gradually US inflation expectations are beginning to creep up. Now, we've monitored these in most of these calls, particularly as the dollar falls sharply. If inflation does gradually reassert itself in the system, and I say gradually, we had some terrible deflationary numbers out of Europe this week, it does threaten the level of bond yields and perhaps argues that somewhere around 70 basis points on the 10-year there on the right is somewhere near the low point that we see for US and global bonds. If that's the case, it could start to put pressure on stock market valuations, the blue line on the right of slide 7. That's the cyclically adjusted PE of the S&P 500. You can see it generally behaves positively to a falling bond yield and compresses in a rising bond yield. So this would be a problem for growth stocks. So while this doesn't mean that this is the end of the growth stock rally and this correction needs to continue sharply from now on, it does put a question mark over the dominance of one sector style and the super caps that we've seen dominate all returns in global stock markets. So what does that mean for our strategy? Well, as you know, we at Saracen are thematic. We hold 5 different long-term themes with a whole plethora of sub-themes underneath. What's encouraging for us is while the digitization theme and to an extent the automation theme are quite tech-focused. Automation in particular has large industrial holdings. Climate change has utilities, particularly defensive, renewables, and capex in smart buildings and power stations. Our aging theme has mainly pharmaceuticals and related developments to healthcare, and an evolving consumption theme which is quite cyclical. So we don't have that industry focus on growth stocks, and it gives us a good thematic perspective, but doesn't hitch us to one investment style. So I'm not calling the end of the growth stock rally. I'm just saying there's a bigger question mark above it than we've seen for some months and even years. Thank you.